Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace, and I'm going to do some listener questions today. But before I do, I just wanted to summarise the new changes that have come into effect given the new financial year that we've just entered into. If you're listening to this podcast now, it's the 14th of July, and I thought it was a good idea just to at least summarise, give a quick summary of what's changed as of 1st of July this year. So firstly, the concessional contribution cap has increased from 30,000 to 32,500. So a slight increase there, just being indexed to CPI. The other one, non-concessional contributions, so the ones you don't get a tax deduction for, that cap has increased from 120 to 130,000. And therefore, if you're using the bring forward rule, which you use the 2 future years and you bring forward those caps to use them, so that's 390,000. So it's just 130,000 times 3. And then the third one is the transfer balance cap has increased from 2 mil to 2.1 mil. So that is if you roll your balance into pension phase, completely tax-free pension phase, that's what the transfer balance cap is. So you can now get 2.1 mil in pension phase. And looping back, just to the concessional contributions, I'll just make the comment as well that, you've now lost anyone that was going to be using unused carry forward concessional contributions over the last 5 years. So that's a sliding 5-year scale. So you've now lost the 2021 financial year. So if you had any unused carry forward concessional contributions in the 2021 financial year and you didn't use them before 30 June, unfortunately, you have now lost the opportunity to use those. So now moving forward, the furthest back you can go is the 2022 financial year, and then you can use any unused carry forward contributions all the way up until the 2026 financial year, which was the last financial year. And then on the super front, the final one, the next change that comes in is the Div 296. So this actually comes into effect. This is what was called the 3 mil super cap. So this actually comes into effect as of the 1st of July 2026. So just to refresh, it's pretty much an additional 15% tax on income earnings over 3 mil. So that was kind of rear vision mirror old news these days with everything that's been happening with tax reform. But yeah, you will recall that one from about a year or so ago. That came into effect just on the 1st of July. So anyone with really large super balances, but also anyone who's projected to have large super balances over the next 10, 20, 30 years, assuming that this legislation stays in place with government changes and whatnot. But there's going to be a lot of people that will get caught by that. But that has come into effect as of 1st of July, the additional 15% tax. So people with the portion over 3 mil would be getting taxed at 30% on earnings. It's not on unrealized capital gains, thank goodness. That didn't go ahead as part of the Div 296, but it is on earnings above 3 mil. And the final change in regards to super specifically is payday super. Now, I think this is a really good thing. I'm a big advocate of this. The changes now 1st of July, employers have to pay their employer super contributions, the super guarantee contributions, within 7 days of each payday. So it's making it much more current when they have to make those payments. I think this is a really good change. And, if you think about it logically, imagine if you're getting paid, but your employer just delayed those payments by months in arrears, you wouldn't be very happy with it. It's no different with super. That's your money that should be going towards you, towards your super fund. So I think that this is a good, really logical change, the payday super. So people will be getting more money sooner in their super funds, which means invested super, and I think sooner in their super, and that's going to help everyone out a lot more. So that is another change, which I think is a good thing that has come into effect. And putting super aside, a couple of little small changes to personal income tax and more broadly tax legislation. So the tax bracket of between the tax-free threshold of $18,201 and $45,000, so that first tax bracket above the tax-free threshold, well, that tax rate's dropping from 16% to 15%. Big whoop, really not a huge amount of change there, but you will recall that was one of the ones that the government brought in. So that is coming into effect now, and it is online to reduce again next year down to 14%, that income tax bracket. So not a massive change there, a 1% shift, the second income tax bracket. A couple of other little things, the $1,000 deduction, so standard deduction for any work-related expenses. So in this financial year, instead of having to keep receipts like you traditionally did have to, it's just a $1,000 deduction for work-related expenses for workers. And for small business owners, the $20,000 instant asset write-off has been extended and made permanent, which is a good thing as well, I believe. So yeah, that has been continued. It was due to wrap up, but it's been extended indefinitely. And then finally, the big one was the changes, obviously, to which has been widely spoken about, to negative gearing and capital gains tax. So this wasn't technically a new financial year change, but it actually passed the Parliament on the 25th of June. So it just kind of coincidentally happened to align pretty closely to the end of the financial year. But look, these have obviously been widely spoken about, but just to quickly summarize, negative gearing no longer available for the purchase of established properties after budget day. So if you bought a established investment property or property of any kind after 7:30 p.m. on the 12th of May, you would no longer be able to negative gear that. But those changes don't actually come into effect until the end of this financial year, so the 1st of July 2027. But the changes have been passed through Parliament, so that is now coming into effect. Doesn't apply, obviously, to other assets, to commercial property, shares, or new build properties. But as I say, for now, you've got another 12 months of which you can negatively gear, and then these changes come into effect on the 1st of July 2027. So enjoy the next 12 months out there for those property investors. And then finally, the big one, the capital gains tax change reforms that got passed. So they have been passed on the 25th of June, but again won't come into effect until the 1st of July 2027. The changes here, obviously, which have been widely spoken about, it's going to be changing from the traditional 50% CGT discount, and then it will shift to an index cost-based methodology with a minimum tax rate of 30% to apply to real capital gains. And so that will come into effect after the 1st of July. And, I think it's going to be an interesting period at the end of this financial year, 1st of July or 30th of June 2027. There's going to be a lot of people out there getting valuations on assets. I mean, shares, that's quite easy. That's not a thing that really needs a valuation. But I'm thinking more about property and businesses, because with this change in capital gains, it's going to be critical, I think, or quite important for people with property and businesses to get a valuation. And I think a lot of people would be hoping that they can get a good valuation, which would, over the long term, it would, in theory, you get more of the overall gains of a 20-year asset hold. If you had more of it on the 50% CGT discount and less of it on the index cost-based methodology, that's going to help you out a little bit in terms of tax calculations. So there's going to be a lot of people, I imagine, I think valuers are going to be very busy pretty much towards the end of financial year, but it'll almost be after the financial year. So they can obviously do them retrospectively, property valuers, business valuers. So I would think, within the 3 to 6, maybe even up to 12 months after the 1st of July 2027, those valuers are going to be doing a lot of work, I'd imagine. So that will be interesting. Now, look, one comment I'll make with these changes to the capital gains tax is it makes it much more confusing. No doubt. I think for the average punter in Australia, this change, when you've got a changing of the capital gains tax treatment at a point in time, and then another treatment applies, it is far more confusing. And even just in itself, the index cost-based methodology is a far more confusing tax calculation. So it makes it hard for people, really. I mean, I know internally we've been working through doing some projections, financial planning for clients, and I was thinking about it afterwards. Traditionally, when we were thinking ahead and planning about an asset sale in the future under the old capital gains tax methodology, well, you really had to input two key assumptions. One, what was the growth of that asset going to be? So we have to predict that and make an assumption about what that might be. And then two, pretty much what's your assessable marginal income tax rate going to be at the point of which you sell it. So with those two pieces of information, the 50% CGT discount, you could accurately, or as accurately as you can by making those assumptions, you could calculate it. But now there's pretty much a third element with this index cost-based methodology. You've got to assume the growth rate, have a guess at the growth rate. You've got to have an idea of what the person's marginal income tax rate's going to be, and you've got to predict what inflation is going to be, because then that's what the cost base gets indexed to. So, I mean, naturally, of course, you can just take a long-term average of inflation. Inflation's high at the moment, but long-term averages, you could say 3%, but that it doesn't run in a straight line at all, obviously, inflation. So, I mean, that's a really hard one to predict as well, inflation, where that's going to go, and over a period of 5, 10, 15 years, what that movement in it's going to be. So it's thrown in a third variable that people are having to factor in when they're trying to do their planning exercises around, retirement planning, asset sales. So yeah, it's an added area of complexity, which, is going to be difficult for a lot of people, I think. All right, we'll jump into some listener questions now. So the first question I wanted to talk about is from Charles. So Charles lives in Melbourne, and I'll give a bit of a rundown on his situation here. So he's 51 and his wife is 47. They're both currently not working. They've got 4 kids, wow, age 7 to 14. Private school fees are there, but they're not sort of massive, 35,000 altogether. And they go on holidays once a year. Anyhow, I'll give you a breakdown. They've got a lot of property assets here. So I'm totaling up, really, I've totaled up, Charles, your overall asset position currently. And it's about 7 mil, and you've got about 2 mil of debt. And I'll break it down for everyone else. So, I mean, you've got an apartment in Singapore worth 800,000, cash of 400,000. Inside your self-managed super fund, all property. So you've got 2 properties, total value 1.2 mil with 900,000 of debt. So really, you've got about 300,000 combined in super, and you're not working, and you're getting close towards retirement. So that's obviously something that needs to be addressed. But then outside of this, you've got, I don't know if I should name all these suburbs specifically for you, but okay, you've got a Queensland. I won't, for your privacy. You've got a property in Queensland worth 1.3 mil with 600,000 debt. Another sort of regional property in Victoria worth 800,000 with 600,000 of debt. Then you've got 3 parcels of land, so pure land, no property, no house on them. And combined of those 3 parcels in regional Queensland is 1.6 mil, no debt. And then he's got another parcel of land in regional South Australia worth 420,000. So minor shares worth 20,000, and then $500,000 in crypto. And then finally, Charles mentions that he has an apartment in Queensland which is currently being built. He bought off the plan, and the purchase price will be, which he hasn't paid yet. He might have paid a minor deposit, but the purchase price will be 680,000, and he believes that he can sell that for 1.6 mil. So he must have entered into that contract a long time ago. Look, yeah, I mean, if that's the case, that's pretty good. But yeah, he hasn't really laid out much, I'm guessing, apart from a deposit. And he thinks he can pay 180,000 and then sell it immediately for 1.6 mil. And so Charles wants to buy a home in Melbourne. So him and his family are currently renting, and he is targeting a property of about 1.2 mil. So he's kind of looking at that Singapore apartment for 800,000 plus the cash of 400,000. That'll pretty much get him on the way. I mean, there's a bit of stamp duty and things on top there as well, Charles, obviously, but that pretty much gets him to the home in Melbourne. So his first question is around, would he do that? Yeah, I think I probably would. Yeah, I mean, you are, like, if taking a step back here, Charles, property heavy and a lot of land holdings as well. And if you're not working, I think there's got to be I'd be thinking there'd be quite a lot of moving of the chess pieces here in your asset base. Like, big picture, you've got the assets there. If I just look at the line item, what's your net asset position currently? Well, it's 7 mil, and there's potentially some upside in that if you buy into that new build property in Queensland and sell it for what you think you can sell it. So there's even some more uplift in your asset position. But, sitting at 7 mil net asset position with 2 mil of debt, that's a good number, I would think, for you. But there's just got to be a lot of movement of the chess pieces here, I think, to really set yourself up well for retirement and making sure that all those assets are really working for you. So, look, yes, I think without knowing the addresses of any of these properties specifically, I'm just looking at moving the pieces around from a structural perspective, I guess you could say. Yeah, I would think using the cash, and I think buying the home is a good idea. You don't want to be renting forever. I think you do want to do that, get the home secured. So, yeah, I think using the apartment in Singapore and the cash to do that makes sense. And then I think selling the 3 parcels of land in regional Queensland in order to buy that off the plan development in Queensland, I think that makes sense. I mean, you're going to pay, there's a lot of costs in doing all this, obviously the transacting costs, capital gains tax, stamp duty, all the way through. There's a lot of moving parts in here that you're going to pay a fair bit by doing all of this. But look, in any case, I still think it seems to be the way to go. I would be, the land parcels, they're kind of not really well utilized assets. I mean, of course, I'm not saying all land assets are poor investments, but you really want to be banking on some large capital growth because you're not getting any income. And then with income then comes the deductibility on costs. So, land without any rental income from it's a real drag, and it needs to be doing pretty good things in terms of capital growth, in my opinion. So, yeah, look, I think definitely you've got 3 parcels, and I'm going to guess they're all near each other. So selling at least 2 of the 3, maybe even all 3 of them, which would then enable you to put some more money into super and to buy that $680,000 off the plan development up in Queensland. And then I'd sell that afterwards. I'd take your profits from that. I really, really think, again, looping back to that, you need to get some more money into super. 300,000 for you and your wife at your age in super. And with that level of debt against the property in your self-managed super fund, you really need to build up some liquidity in that super fund to prepare you for retirement. So I think with some of the sale of these properties, making some non-concessional contributions is going to be the way, making concessional contributions as well to minimize the capital gains tax if there is some from the sale of these properties. So, I spoke about a while ago, there was an episode that I did called The Liquidity Trap, which is episode 337, and it aired in December 2024. So I really encourage you, Charles, to have a listen to that episode, not to sort of toot my own horn or, anything, but I think it's completely relevant to your situation, or anyone that has a large amount of property and debt inside a self-managed super fund and they're nearing retirement and they don't have a lot of other liquid assets in there. It's really important to have liquidity in there so you don't get stuck in that liquidity trap. So I'd encourage you to have a listen to that one. Charles asked another question about should he sell the Victorian regional property with a house on it and use that cash to build up one of the Queensland regional lands, so the parcels of land, and then sell it for a profit. And he sort of mentioned some indicative numbers here and what he thinks maybe a profit could be. Again, I mean, you could run the numbers on it and do a proper feasibility assessment on that, but I just don't think you are property massively heavy here and don't have too much else outside of it. So for that kind of margin there, Charles, I'd be pretty reluctant. It doesn't seem to be stacking up to me, but look, you can do your feasibility on it, but I don't think, I wouldn't be. I'd be keeping yourself more liquid. I'd be sort of divesting some of this property and preparing yourself for retirement. So I don't know if that stacks up doing that. Charles also mentions, I hope to get my age pension when I hit 67. So I think, if you're talking about the government age pension, there's no chance you're going to be eligible for the government age pension based off your assets, the assets tests. You're way over the top with all these assets. So but maybe, I think that you're talking about that because you mentioned 67. That's when the government age pension eligibility kicks in. So, you certainly wouldn't be getting the government age pension, but you are going to need to be self-funded retiree. You're going to need to fund it yourself through super. So maybe there's a chance there you're talking about the pension from super. And yes, you could access that at 60 because you're no longer working. So you don't need to wait till 67 for that. But, you're going to have to set yourself up, no doubt, in order to be a self-funded retiree, which is a good position to be in. So you should. I'm looking at roughly 7 mil of assets, 2 mil of debt, 5 mil net asset position. There's no way you're getting a government age pension. So, and that's a good thing. You've done well to get yourself to this position. And so Charles's final question is, can I afford to retire? Well, yeah, I think you can. Yep. The net assets are there. As I said before, your overall asset position is strong. If most people could retire with 5 mil net asset position. Now let's remove, I like to talk about investment assets, net investment assets, remove the home because you're not going to be able to live off the home in retirement, obviously. But, if you remove the home, then we're talking maybe 3.8. If you're going to put 1.2 mil of that 5 mil and you're going to put 1.2 mil into the home, well, 3.8, yeah, I think you're looking pretty good, Charles. And I don't know how much you and your family spend, but I'd guess that that's going to be a pretty good number for most people. So I think you are. And there's a bit of uplift here if you can sell that off the plan apartment in Queensland for the profit that you're talking about, then that's going to give it a bit of an uplift as well. So yeah, but overall, I think you're in a good position, Charles. And yes, I reckon you will be able to retire. And this, of course, is not personal advice. This is just information. I'm just looking high level at your situation and speaking generally, of course. But I think there's got to be a fair moving parts to set yourself up well. So you've got the asset position there, but you just need to restructure things to position yourself well for retirement, as I sort of discussed in this answer. So I hope that helps, Charles, and best of luck to you. The next question now is from Matt. So Matt and his wife, early 30s, 38 and 34, so mid-30s, excuse me. After working very hard for many years, they bought their family home I won't give the exact suburb, it's in regional New South Wales. And look, a really good result here. So he mentions they bought that property for 1.85 mil. And then they undertook significant renovations within the first 3 to 5 months of purchasing it. And he believes he spent about $300,000 on the house and $100,000 on a pool. So about $400,000 they deployed into it. And he has been given recent valuations of about 2.7 to 2.8 mil. So it's, gone up in value within a fairly short period of time based off those valuations by $1 million. And he's only spent about $400,000. So pretty good result there, Matt. It's sounding quite good, especially given that you only bought the property in April 2025, not that long ago at all. So yeah, that's a pretty good outcome. And so he mentions that they love the house. It's going to be their home for the foreseeable future for the next 20 years at least. He mentions that they do have some more work that they want to do on it. So in the short term, in the next sort of 4 to 5 years, they want to do maybe 120,000 just on new bathrooms, driveway and roofing. And then longer term, in 8 to 10 years, there's some further works around an extension to the living room of about 300,000. So there's a little bit more work to be done over the sort of medium to long term on it, which is fine. So look more broadly outside of the home. Matt and his wife have a combined household income of about 360,000. Got some cash in offset. So the mortgage they've got is roughly $1 million, and they've got about 200,000 in offset there. So decent offset balance. That's looking quite good. Super funds of 300,000 and roughly 200,000, and a few other bits and bobs really. But it's the home and super and cash makes up the absolute large portion of their overall asset base. So really, Matt's questions revolve around, what should he do next? He's given some options here, which are will just make additional mortgage repayments with the surplus cash flow that they've got, which I imagine they would have decent surplus cash flow. He hasn't mentioned it, but the mortgage repayments shouldn't be too crazy. On $1 million and based off your income of 360,000, so you'd have good surplus cash flow, I would imagine. So you could make additional mortgage repayments. Option two, he's mentioned, go down and buy an investment property. And then third option, he's not sure, maybe something else that he's not aware of. So, what would you do? Well, I wouldn't be too worried about the mortgage repayments. I naturally think, okay, do we have enough cash to fund those renovations in future and not have to go and borrow more money? Even though it's kind of net result, whether you borrow more, increase your mortgage to then fund renovations or use cash from offset to fund renovations, it's kind of the net same result because it's just all non-deductible debt. So, but it just means you don't have to reapply and then get a bigger mortgage and have higher repayment commitments. So I generally think if you can fund it from cash in offset, it's just a whole lot easier and better for your cash flow. So I think, if in 4 to 5 years you need about 120,000, when you've already got 200,000 in offset, and then in 8 to 10 years you might need 300,000, I think you're naturally going to build that up over time. So I think it's worth getting investing, Matt. I think for me, that kind of says your mortgage is under control. You've got some cash buffer there to fund these future renovations, which aren't for another 5 to 10 years, and they're not wildly massive either. So I'd say you need to get investing. So, I mean, naturally, then you look at, well, super, making sure you top up super up to the $32,500 for you and your wife. Your employer contributions would be reaching it already, but your wife's has a little bit to top up. That's minor. That's not going to use up a lot of your cash flow. So then outside of that, do you go down investment property or do you invest in shares, the two major asset classes? And I mean, I don't think I'd do investment property now without the negative gearing. We've spoken a lot about it. Stuart has spoken about. I think at the moment I'd be reluctant to do it. Those negative gearing tax reforms, that might not last forever. There's a number of countries throughout the world where that has changed. They've taken negative gearing away and then given it back. So, nothing lasts forever. But I think at the moment, I don't think I'd recommend buying an investment property. You could probably do it. I imagine you'd have a little bit of borrowing capacity. You might just be able to get there, but I don't think I would do it without the negative gearing benefit. So look, the other options are you can invest. Look, you can invest in shares. You'd probably do it in your wife's name. Is it worth setting up another entity to do it? Again, I probably wouldn't set up a family trust at the moment, just given the uncertainty with that. We're going to find out where that sits pretty soon. The government really broke apart this new tax reform into two major things. So as we know, as I spoke about before, the negative gearing and the capital gains tax has got through, and they had to throw in as well as a little additional supplementary benefit, the no borrowing in self-managed super funds to get it across the line. So that's through, but then they haven't yet put forward the legislation around family trust, the new minimum tax of distributions of 30% from family trust. So going on a bit of a tangent here, but we will find more about that pretty soon. But look, so I don't know whether I'd be setting up any entity. I think I'd naturally just be putting it in your wife's name. I think you have mentioned here that you probably plan to have 1 to 2 more children, and you've already got one young child. So I think, wife's in a lower tax bracket and it's foreseeable that she's going to have some time off work with a lower income. So I think naturally you'd put sort of investments that are cash flow positive in her name, naturally. And then, the question then is, could you add some gearing into it? So rather than just investing cash, with your surplus cash flow, investing that into shares in your wife's name, well, I think a good strategy is direct all surplus cash flow to the offset account for your mortgage and then borrow to invest. And so, because you would have borrowing capacity, you'd have a little bit. So say it's maybe a couple 100,000, you might be able to borrow more than that. But if you just used or borrowed, a few $100,000 to invest in shares, that can still be negatively geared. And it's a really good way just to kickstart a share portfolio, I think, rather than starting from $1 and investing each month with the surplus cash flows. So you could look to do that, sort of kickstart it. It's not really going to impact any of your other plans. As a bit of a side note, Matt, this is something that we've sort of been discussing internally about our view on investing in established residential property. This isn't a thing that's going to last forever, but it's just for the moment, we're a bit soft on it or a bit cold on it. But what we're kind of doing now is just looking at, well, that might come about again in the next couple of years. And of course, there's some people who still buying investment properties makes sense for them, buying established investment properties just because of their cash flow and tax position. There's some people that it still applies to. So I just thought I'd mention that it's not ruled out for everybody, but I think these things aren't going to change, but they may change at some point. But the point here is don't make changes, pivot the plan for the moment, given these tax reforms. However, hopefully those pivots and changes don't impact what you could have been doing or could do in 2 years' time. So what I mean by that is if you go and borrow a couple 100,000 to do some share investing in your wife's name, will that impact your longer term plans around doing these renovations? Maybe you buy an investment property in a couple of years. Well, if the answer, which I think it would be, is no, you're still going to be able to do that, then by doing this bit of gearing into shares or investing in a share portfolio without any gearing, you could just do it with cash flow. That's not going to impact that. So I think that that's a reasonable step to take. And that's sort of the approach that we take to it. It's do what you can based off the circumstances right now, but do think about whether taking that action will impact your long-term plan. So that's kind of my thinking towards it. So I'd think that would probably be the way. I'd think using that, borrowing to invest in shares, putting all surplus cash flow in the offset account. Some people call that debt recycling. It sort of is a bit of a broad-based term, that debt recycling, but it is a form of debt recycling. That is. So I'd consider that. And, the other comment I'll make here, Matt, is that really your strategy is you're putting a lot of money into the home, and that's okay. I think we call that live vesting. That's the term. I guess there's a lot of different things you could call it, but we call it live vesting. And Stuart actually did a podcast on this quite a while ago, episode 317, if you're interested. It's from August 2024. I think we're going to see a lot more live vesting now, given these changes to negative gearing and capital gains tax. The main residence exemption was not touched at all. So nothing's changed. So you've still got the main residence exemption on your home. So I think we're going to see now a lot more people live vesting, which is that investing more in your home, building, creating all that equity in your home. Naturally, then the assumption is that you want to sell down, downsize at some point. But not necessarily even, because the equity in your home is still useful even if you don't sell. It's equity that you can secure debt against. So you can borrow against it if your income allows you to and you meet serviceability. But equity in the home is really useful in terms of borrowing. So, there's that added benefit of the live vesting approach. But, the no capital gains tax is a massive one. So you're pretty much doing this, Matt. I mean, you've got, over $1 million of equity in the home. And, that is the absolute large portion of your asset base at the moment, which is totally fine. That's completely normal for your stage of your wealth accumulation journey. So, you've done really well from it. I think all these steps you've done in terms of the renovations you've made has added great value to your home. So you're creating really good equity in doing that. And, if these further improvements and renovations that you're going to do the home are going to increase that equity even further, then great, and I think if you're building that equity in the home, you either then downsize further down the track. I know you mentioned that it's going to be you love it and it's going to be your family home for the next 10 to 20 years at least, but it's still useful. If you ever need to then downsize to fund retirement, that'll, in 20 years time, I'm sure you'll do well off that. But then also then there's the borrowing power off that equity in the home. So, I think there's a lot more people, just as a broad-based comment here, I think there's a lot more people that are going to be investing heavily in the home and really maximizing the advantage of that main residence exemption. I mean, when you change the tax treatment and then you change the goalposts, people will naturally work within those to find the best avenue forward. So I think we're going to see quite a bit more of it. Okay, I've probably got time for one more question now, and this listener would like to remain anonymous. It's a good question here. So she mentioned she's 52, female and single, and she has 3 kids from the ages of 14 to 18. And, she mentions here that a lot of our questions are often around couples, and it'd be good to direct this question to her, being a single parent. So I think this is a good one to address. She goes on to mention a bit of information about her situation. She owns the home, very minimal debt. So the home's up in Sunshine Coast, worth $1.5 million, loan of $280,000, but $210,000 in offset. So almost paid off there, which is great. She's a sole trader, income of about $120,000 roughly, very minimal expenses, lives very frugally by her words. So doesn't need too much to live off. She's got a share portfolio, direct share portfolio of $82,000. She mentioned she used to trade more, but she's too busy to watch it now. And look, and this is not poking any fun at your share trading approach at all to this anonymous listener, but, I just wanted to highlight this in that you mentioned, so she goes on to mention, she had some Origin shares. They've done quite well, purchased them at $4 and at $12, good dividend. Bought CSL, well, that's halved in value, as anyone who's seen CSL shares in the last 12 months has done very poorly. I won't name all of these, but another one's lost 30%. Another stock, which she bought, is pretty much hasn't moved at all. So you see here, through this pretty concentrated said there's probably 5 or 6 different stocks in this share portfolio, and it's not a big deal at the end of the day. It's only an 80 grand share portfolio. But the point I'm trying to make here is this just highlights stock picking of Australian stocks. This is active management, what you're trying to do yourself. It is active management and stock picking of individual stocks. It just doesn't work. Like, have a look at the results here. And again, I'm not being critical of you at all, but this just highlights for anyone else out there, stock picking 5 different stocks. The overall results have been not very good here. So it just goes to show that it doesn't work, particularly for the average person, but even highly experienced active fund managers struggle to do this. So, I think hypothetically in another situation, if you had to just played the index, kept diversified, low cost passive, had more international exposure, just did a really simple like diversified ETF, you would have done better. Like, no question, you would have done better over a longer period of time. So look, anyways, that's just the point that I'll make about that. And for anyone else out there, that it can go really poorly and it's really hard to pull off when you're doing a concentrated portfolio like this. So moving on, her question's just around how does she prepare for a comfortable retirement? Really what should she be doing moving forward? Should she sell some of these direct stocks and put money into super? Really the question is, what else should she be doing from now until retirement? Well, in your situation, I would be keeping it really simple. I would be focusing purely on super. So I didn't mention before, your super balance is 385,000. So I think all of your surplus cash flow and all of your effort should be going towards super. Make your concessional contributions and then also make non-concessional contributions. In a situation like yours, we don't need to overcomplicate it. You've mentioned here, should I consider property? My borrowing capacity is a bit limited. No, I don't think you should do that. I don't think you should add borrowing into the equation, or I don't think you should add an investment property into the equation. I think it's kind of super should be the cornerstone of most people's retirement plan. And when in your situation, when you're looking at home's almost paid off, that's great. Only a little bit more to left to pay that off. Of course, you'll do that. But when we've got 385,000 in super and we are 52, that has to be the cornerstone of what you are focusing on. So there's nothing wrong with that. It's going to be very simple. For most people, if they have the home paid off and then a really healthy sum in super, that's great. I think you're off to the races with retirement. Adding other things in there, and especially when you're this close to retirement, you're 52 now, you don't have the time frame to be going and doing leveraging up and borrowing and buying other investment properties. It's not going to help you. So I think keeping it as simple as possible. But then the next key is, if by putting more into super, we've got to make sure that's working well for you. So you mentioned here, is there a better industry super fund has lower fees? So she mentions she's with AMP Super and she says the fees are exorbitant in her words, and she's got a 20% high growth portfolio. So she's kind of, again, I don't really think this is a great idea when people kind of construct their own portfolios by doing 20% in high growth and 80% in conservative or balanced, and then or instead doing 50% high growth, 50% balanced. What you're doing is just creating a balanced portfolio, a growth portfolio. I think people sort of try and construct these to their own risk profile. Just pick one of the risk profiles that they have. It's all the same underlying assets, just in different proportions of growth and defensive. So in doing that, you're pretty much just creating a growth portfolio. So I would just pick one. Just pick a growth portfolio. Keep it very simple. Whatever your risk profile is, if you want to be in balance because you're a bit more conservative, fair enough, no problems. Or if you want to be high growth because you're a bit more aggressive, no problems. But just pick that option and go with it. There's no point sort of constructing these portfolios yourself, because you're not actually really constructing the portfolio. It's all the same underlying assets, just in different proportions. So I'd encourage you to do that. In terms of, is there a better super fund? Well, Stuart will be coming out very soon, within the next month, with the super fund returns for the top 8 industry super funds. I believe he's benchmarking against, including also Vanguard Super. So we do that every year. I think that'll be a really good one for you to listen into. So there's a lot of considerations in there. So in that, there will be performance and fees, but there's a lot of considerations in terms of selecting a super fund. And, it's kind of really relevant to your situation here, because super will be your absolute retirement. It'll pretty much be outside of your home, the number one asset that's going to fund your retirement. So making a good decision with that is critical for you. So I would really encourage you to read that blog when it comes out to assess, the different performance and fees, and us comparing the different industry super funds that are out there. And that can help you make a good decision with all of the other factors to consider when considering a super fund choice. So I think have a look at that when that comes through. The other advice I would have is, I think I would probably go and sell those shares, to be honest. That collection of direct stocks that you have, I don't think, in my view, you're going to see above average returns. I think you're going to get better returns from just putting the money into super. Getting a tax deduction on the way through will absolutely put you in a better position. But even if it was non-concessional contribution, contributions, just putting that money into super, even after paying a bit of capital gains tax, which there probably isn't any because of the CSL shares. So you're probably overall running at a capital loss if you sold all those. So there's probably no capital gains tax. It's going to be invested in a tax-friendly environment. And I think actually using a super fund to invest it, I think you're going to get better returns on it. So I probably would. I would sell those shares. I would just double down on super and get as much in there as possible, would be my advice to you. And finally, to the last question, are you on track for a sufficient super fund and for retirement for a single parent in your position? Look, I'm not sure. It's a bit line ball. There's a bit of work I think that needs to be done. I don't know. I think your retirement age probably won't be 60. It'll be 65 at least. I think you need to keep working and really building up that super. I'd encourage you, there's a lot of online super calculations, like doing the actual projections for you and answering that question, do you have enough to live off? Because you've got a very simple situation where it's just the home and then a super balance. If you just jump onto some online calculators, which, probably the super fund that you choose, and a lot of the industry super funds have these online calculators, doesn't really work for people with complex affairs and other assets because they just don't work with those. But if you are very simple in that you've got the home and you know how much you spend and how much you need to live off and you've got a super fund, well, then it's a pretty easy sort of calculation to plumb into one of these calculators just to say, well, how much do I need to live off to have a comfortable retirement based off a balanced or growth type return from my super fund? So I think you could do that, jump on and use that, and that will give you then an indication how long you need to keep working in order to build up your super to then comfortably retire to draw upon. So whether you're on track on it, I don't know, but I think with those tools, you might be able to find the answer to it yourself. Okay, I hope that helps you. I've run a little bit over time here, so I'm going to wrap it up, but until next time, bye for now.
Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.